Imagine waking up on February 8th, 2026, and the first headline you see is that Japan is about to make a decision that could ripple through every corner of the global financial system. Not tomorrow, not next week. Today. And the kicker? Most investors in the United States won't even notice until it's too late. But you, watching this video, will understand exactly what's happening before the headlines hit and why it could flip the US stock market almost overnight. Let's start with a scenario. Picture the Japanese economy as a vast, carefully balanced machine. For decades, it has struggled with something unusual: deflation, prices falling. At first glance, that sounds like a dream. Your money buys more over time, right? But the reality is far from ideal. When prices drop consistently, consumers delay purchases, businesses hesitate to invest, wages stagnate, and slowly the entire economy moves in slow motion. This is not theory. It's the reality Japan has lived in for more than 30 years. And to combat it, the Bank of Japan deployed tools that most of the world would consider extreme. Interest rates weren't just low, they were negative. Imagine lending someone $1,000 and expecting to get back $900. Sounds absurd. Yet this became the normal for Japan. The Bank of Japan, the country's central bank, was willing to absorb losses to keep the engine running. Meanwhile, Japan became a global powerhouse in dollar holdings, sitting atop over $1 trillion in US Treasuries. This might seem like a dry statistic, but it is at the core of why a single policy decision in Tokyo can shake Wall Street. Now here's the twist. Japan's battle with deflation has shifted dramatically. Inflation is creeping in. The very policies designed to stimulate growth are now colliding with rising prices. And on February 8th, the Japanese government faces a critical choice: continue aggressive money printing or tighten the monetary reins to cool inflation. The path they choose doesn't just affect Japanese consumers or companies, it affects global liquidity, borrowing costs, and ultimately your portfolio. Let's talk about the first domino, the yen carry trade. For years, Japan's ultra-low interest rates created a rare financial opportunity. Investors borrowed yen at near zero rates, then converted it into dollars to invest in higher yield assets across the world: US stocks, real estate, crypto, even corporate bonds. Essentially, cheap Japanese money has been quietly propping up markets far beyond its borders. Now imagine if Japan raises interest rates. That cheap yen evaporates. The flow of capital into US assets slows. Stocks feel less buying pressure. Suddenly, what seemed like stable growth can wobble in the blink of an eye. And it's not just the carry trade. Consider Japan's housing market. Nearly 80% of mortgages are variable rate. Contrast that with the US, where it's under 10%. Rising interest rates here don't just make monthly payments higher, they can push homeowners to the brink of default. And when defaults spread, history shows that financial systems feel it fast. The 2008 crash wasn't ET caused by one country alone. It was a domino effect fueled by interconnected debt. Now, Japan could trigger its own subtle version of that. Then there's the US Treasury angle. Japan holds around $1.2 trillion in US government debt. Their buying has helped keep US borrowing costs low for years. But if Japanese investors find domestic yields more attractive because rates rise at home, those dollars may not flow as freely into US Treasuries. When that happens, US interest rates have to climb to attract buyers. And when Treasury yields rise, it's not just Wall Street that feels it. Mortgage rates, car loans, business financing, all of these costs climb, tightening the financial environment for every American. Imagine if the US stock market, which many investors believe is resilient, suddenly loses one of its quietest sources of support. It's like a high wire performer depending on a single safety line, and Japan's policy could pull that line at any moment. Before we dive deeper, think about this. The decisions made in a country halfway around the world can affect your mortgage rate, your 401k, even the timing of your next investment. Does that make you reconsider the headlines you scroll past each morning? If yes, comment "I'm watching" below so we can see who's truly paying attention. Back to Japan. Their policy challenge isn't just about rates or liquidity, it's about debt. Japan carries a debt load roughly 240% of GDP. To put that in perspective, the US hovers around 125%. And yet, the government is contemplating additional money printing to stimulate growth. That's a delicate tightrope walk. Print too much, and inflation accelerates. Print too little, and economic growth falters. The stakes couldn't be higher. And here's a subtle but crucial point. Japan's corporate culture is shifting. For decades, Japanese companies prioritized stakeholders, employees, customers, even suppliers, sometimes over shareholders. Profits were important, but stability and long-term relationships came first. Now, there's a move toward a more shareholder-centric approach, closer to the US model. That means dividends, buybacks, and efficiency are becoming central. For investors, this isn't just an academic shift, it's real opportunity. Companies are becoming more profitable and potentially more rewarding to shareholders, just as their macroeconomic backdrop becomes more volatile. Let's layer in history for context. In the 1980s, Japan dominated global manufacturing, its stock market surged, and then it collapsed in the early 1990s after asset bubbles burst. What followed were decades of stagnation, deflation, and experimental monetary policies. Fast forward to today and we see a similar pattern, but with a new twist. Japan is a trillion-dollar holder of U.S. assets. The global economy is more interconnected than ever, and a single policy decision can cascade across continents. This is history repeating itself, but in real time, with your investments on the line. Policies meant to help Japanese consumers, like higher rates to control inflation, could actually benefit investors in certain areas of the U.S. market. How? By creating volatility and liquidity shifts that savvy investors can navigate. Timing matters, knowledge matters, and understanding the link between Japanese monetary policy and U.S. financial markets gives an edge that headlines alone will never provide. Now, let's think about practical implications. If Japan continues aggressive money printing, the yen carry trade thrives, U.S. stock market inflows remain strong, and global liquidity supports asset prices. But if they tighten, cheap capital withdraws, Treasury yields rise, borrowing costs climb, and suddenly the high valuations in U.S. equities and real estate feel heavier. Every investor holding leveraged positions or planning a major purchase could feel this immediately. Imagine a scenario. A hedge fund borrows yen, converts it to dollars, and invests in tech stocks. Japan tightens rates unexpectedly. The cost of borrowing yen rises. That fund has to unwind positions. Suddenly, multiple tech stocks experience selling pressure. It's a ripple effect that starts in Tokyo and hits New York within hours. This isn't theory. Markets move on expectation, and even the hint of policy change can trigger real capital flows. Before we continue, here is a quick reflection. How many times have you checked a financial news headline without understanding the broader context? Japan. It's February 8th. Decision is the kind of event where context isn't T optional. It ES everything. If you understand the dynamics at play, you're not just reacting, you're anticipating. And anticipation in investing is often the difference between opportunity and loss. Let's switch perspective for a moment. Think about the average U.S. household. Rising Treasury yields mean higher mortgage rates. Rising interest rates in Japan mean less global liquidity. Both factors tighten the economic environment. Yet, many investors remain unaware of these indirect connections. This is where knowledge translates into advantage. By understanding these global interconnections, you can position yourself to weather volatility or even capitalize on it. And here is the surprising twist. Japan's debt and demographic challenges mean that their decision is not only economic, but also political. An aging population, shrinking workforce, and domestic pressure to maintain social services all play into monetary policy. The government's decision on February 8th reflects not just numbers, but societal pressures. That's why this is more than a technical interest rate story. It's about human behavior, expectations, and the delicate balance of power in one of the world's largest economies. At this point, you might be asking, so what should I do with this information? That's exactly the right question. First, awareness is the asset. Knowing that global liquidity, the yen carry trade, treasury demand, and corporate policy shifts are linked gives you a framework for interpreting market movements. Second, timing matters. Investors who understand these patterns can anticipate volatility and adjust positions strategically. Now we move into solutions and actionable strategies. February 8th is not just a date, it's a signal. The path Japan takes will shape not only the yen, but also the flow of capital, interest rates, and risk premiums across the globe. For some investors, it could mean opportunity. For others, exposure to risk. Before we get to the actionable insights in the next section, take a moment to consider this. Every policy decision has unintended consequences. The choice between stimulating growth and controlling inflation is not purely mathematical. It's psychological, it's political, and it's global. Understanding this is what separates reactive investors from proactive ones. If this resonates, and you want to make sure you catch the next part where we break down exactly how to navigate this February 8th shock, comment "I'm ready" below. Engage with this discussion now, because the insights will give you a real-world edge for your investments. Now that we understand the stakes, let's explore the domino effect in detail. Start with the U.S. stock market. When Japanese investors pull back from buying U.S. Treasuries, yields rise. That's simple supply and demand. But the consequences ripple far beyond the bond market. Rising yields make capital more expensive across the economy. Companies face higher borrowing costs. Consumers pay more for homes and loans, and suddenly, earnings growth expectations start to shift. The same stocks that seemed stable yesterday may now feel the pressure. Here's a historical lens. Remember the 1994 bond market shock? The Federal Reserve unexpectedly raised rates, and U.S. stocks sold off sharply. The lesson? Even small shifts in monetary policy, when unexpected, can trigger outsized market reactions. Now, replace the Fed with the Bank of Japan. The stakes even higher because of Japan's outsized dollar holdings. The lesson is clear. Markets are not just local. They're global, and they respond instantly to liquidity shifts anywhere in the world. And it's not only about rates. Consider investor psychology. Imagine being a U.S.-based fund manager who has relied on cheap yen carry trades to generate returns for the past several years. February 8th approaches. Japan hints at tightening. Suddenly, positions that once seemed low risk now carry a new kind of risk, policy risk from a foreign government. The market anticipates moves before they even happen. That's why rumors, statements, and minor adjustments in Japanese policy discussions can cause preemptive selling or repositioning in U.S. markets. Here's where it gets more interesting. Not all sectors are equally exposed. Tech stocks, heavily dependent on growth financing, are more vulnerable to rising global rates. Real estate, sensitive to mortgage costs, reacts quickly to changes in Treasury yields. Even commodity prices can shift as the dollar strengthens or weakens based on Japan's actions. What seems like a distant policy decision transforms into tangible financial consequences for everyday investors. Pause for a moment and consider this. The February 8th decision is not merely about numbers on a central bank sheet. It's about leverage, psychology, and timing. Every major investor, hedge funds, pension funds, sovereign wealth funds, is watching, recalculating exposure, and adjusting risk in real time. For a U.S. investor, understanding these signals is like having a weather forecast for financial storms. You can't control the storm, but you can choose whether to be caught off guard or prepared. Now, let's layer in Japan's corporate and demographic reality. An aging population, shrinking workforce, and mounting social obligations constrain policy flexibility. Raising rates too aggressively risks slowing growth, causing defaults, and pressuring households already facing rising costs. Conversely, continuing aggressive stimulus risks overheating the economy and sparking inflation beyond control. February 8th is the fulcrum point where all these pressures converge, and it's exactly this tension that creates market opportunity for those who are paying attention. Imagine you're an investor tracking ETFs that include Japanese companies. The shift from stakeholder first to shareholder first culture means more buybacks, dividends, and efficiency. Historically, Japanese firms have prioritized stability over short-term returns. Now, some of those same companies are becoming more aligned with the incentives U.S. investors are familiar with. That's a subtle, yet powerful shift, one that could reward long-term investors who position themselves now. February 8th doesn't again just move markets once. It sets expectations. If Japan signals tighter policy, global investors adjust portfolios, interest rates rise, and liquidity flows tighten over weeks and months. That's why anticipation matters more than reaction. The first ripple happens in Tokyo, the second in New York, the third in your portfolio. And let's not forget the currency angle. The yen's value is a barometer of investor sentiment. If Japan tightens rates, the yen strengthens. For U.S. investors holding foreign assets or multinationals with exposure to Japan, currency fluctuations can add an extra layer of impact. Imagine your investment returns being subtly influenced by a decision made thousands of miles away. This is why global macro understanding is no longer optional. It's essential. Now, here's a historical comparison you may find eye-opening. In the late 1980s, Japanese asset prices surged while the yen appreciated sharply against the dollar. Global investors were caught off guard. U.S. stocks experienced volatility. Lessons from that era? Highly interconnected economies amplify policy changes. And today, with even faster information flow, the reactions are immediate, not delayed. Here's a question for you. What happens if investors overreact? Markets are reflexive. Panic selling or hasty repositioning can exacerbate volatility, but the informed investor sees patterns, anticipates potential moves, and differentiates temporary noise from structural shifts. That's exactly what February 8 presents. A rare moment to observe, interpret, and position strategically before the broader crowd reacts. Let's shift focus to practical implications for U.S. investors. First, monitor Treasury yields. A rising yield environment affects borrowing costs across the economy. Mortgages, car loans, corporate financing all become more expensive. Second, watch sector exposure. Growth-sensitive stocks, heavily leveraged firms, and real estate are most immediately impacted. Third, consider Japanese equity exposure. Funds and ETFs offer a way to capture potential upside as corporate governance shifts toward shareholder focus. Before we dive deeper, let's insert a pause. If you're tracking your portfolio, ask yourself this. Are your holdings prepared for a sudden liquidity shift driven by a foreign policy decision? If not, now is the moment to think critically. Comment below with I am positioning if you want to follow this story in real time. Engagement here ensures you stay ahead of the macro curve. Now, let's layer in another dimension: the interbank lending system and global derivatives markets. Japanese monetary policy doesn't just affect U.S. stocks. It influences swap rates, hedging costs, and derivative pricing worldwide. Even if your investments are domestic, they are indirectly touched by these flows. Think of it as a spiderweb. Tug one strand in Tokyo, and the vibration travels across the globe. For sophisticated investors, understanding these subtle channels is the difference between insight and hindsight. Here's a dramatic scenario to illustrate the stakes. A major U.S. fund relies on low borrowing costs to finance positions in technology and consumer discretionary sectors. February 8th arrives. Japan tightens rates more aggressively than expected. Yen strengthens. Carry trades unwind. Treasury yields spike. Overnight, cost of capital jumps. Positions that once seemed safe now carry risk. Panic selling spreads. And within hours, market sentiment shifts dramatically. This is not hypothetical. It's precisely the kind of chain reaction that informed investors anticipate, not react to. Now, consider long-term strategy. The key takeaway is not to panic, but to map exposure and opportunity. Diversification becomes essential. Global macro awareness allows investors to hedge risk intelligently. Japanese equities, U.S. Treasuries, dollar-denominated assets, and even commodities can all play a role in a balanced approach. The February 8th decision is a pivot point. How you position your portfolio around it determines whether it's a moment of opportunity or risk. Let's add another twist: inflation. Japan's move to control rising prices may slow liquidity, while the U.S. simultaneously navigates its own inflation trajectory. Cross-border capital flows, interest rate differentials, and currency shifts all converge, creating complex dynamics that affect asset allocation. This is why macro-level knowledge is no longer academic. It's actionable. Now, before we move toward the final insights, here it's a cliffhanger to consider. Japan's monetary policy doesn't operate in isolation. Every central bank, Fed, ECB, Bank of England, monitors, reacts, and sometimes preemptively adjusts in response. This creates a dynamic, constantly shifting global financial environment. Anticipating these moves requires more than casual observation. It requires understanding the interplay of policy, liquidity, and investor behavior. Here's the actionable insight. Investors who recognize the signals, track flows, and position accordingly can exploit temporary dislocations. This is not speculation. It's disciplined, informed positioning. For example, sectors with low sensitivity to global rates may outperform during a tightening cycle, while sectors highly dependent on liquidity may face headwinds. Currency hedging can protect foreign exposure. Portfolio rebalancing around Treasury yields ensures resilience. Every tactical choice matters when global capital moves overnight. Another historical parallel: the 2008 global financial crisis. Policy missteps, liquidity constraints, and interlinked exposures caused rapid contagion. The difference today is knowledge. If you understand the link between Japan's February 8th decision, U.S. market liquidity, and Treasury yields, you gain foresight that was unavailable to many investors in previous crises. Imagine you're watching this unfold in real time. Markets twitch, headlines flash, and the first reactions are emotional. But the informed investor, who understands the macro chain from Tokyo to New York, can separate signal from noise, anticipate flows, and act decisively. This is where education, awareness, and strategic thinking become your edge. Now, we arrive at the core insight. Japan's February 8th decision is not merely about their domestic economy. It's a global leverage point. It influences capital flows, treasury yields, borrowing costs, corporate behavior, and investor psychology worldwide. For U.S. investors, this means understanding these channels is no longer optional. It's essential. This decision could tip the balance, subtly or dramatically, in sectors, asset classes, and portfolios. Here's a final practical consideration. Keep a close watch on Treasury yields, the yen, Japanese equity fund flows, sector sensitivities, and global liquidity signals. These indicators will give early warnings of shifts in risk and opportunity. And remember, the first ripple often precedes the tidal wave. Anticipation, not reaction, is the key to navigating February 8th effectively. Before we conclude, reflect on this. The story of February 8th is a story of interconnected economies, shifting policies, and investor behavior. It's a reminder that the world of finance is global, complex, and instantaneous. Those who recognize patterns, understand leverage points, and anticipate shifts will be the ones who turn potential disruption into opportunity. If this story has helped you see the global market differently, hit the subscribe button and join a community of investors who watch, learn, and act strategically. Share your thoughts below. What are you watching for on February 8th? Engagement and discussion help you think critically and stay ahead. The global financial system moves fast, and your awareness is your advantage. February 8th is coming, markets will respond, capital will flow. And the choices made in Tokyo could echo across every portfolio, every sector, and every investment decision. The question is, will you be watching or will you be reacting?